A lot of those social stocks, by the way, were down in today's session ahead of Meta's print. Karen, I'll go to you first. Is down 22% warranted?
It seems a little overdone to me, but, you know, we talk about the 3-day rule all the time, and certainly I think, you know, let this shake out. Also, we haven't heard the call yet, and so very often we get some different color on the call than what we get from the release that they put out. But, you know, there was a lot to not like, and Julia hit on most of the high points there. Obviously, that 3 to 11% growth, that was the spookiest thing about it. You know, I try to think back, there was a time in 2018 where they missed on revenue, they missed on growth, I think, and the stock went down about 20% then as well. At the time, it was also sort of under a cloud of Cambridge Analytica and whatever the, you know, PR du jour thing was then. So to me, it seems like it's kind of overdone, but I want to hear what's on the call. The thing that I actually didn't expect that they talked about enormous CapEx numbers for next year, but they weren't very different at all from prior CapEx numbers. I thought they would kind of scare the street with very, very big CapEx numbers. That did happen in the fourth quarter, but they didn't cite that for this current year that we're in. So that was actually a little bit surprising to me. I mean, all that having been said, though, I think this reaction is quite extraordinary. But let's hear more color from them. I'm neither a buyer nor a seller at this today right now.
The CapEx line was one of the first things I went for in the earnings release because I thought, hey, it just changed its name to Meta. It's going to spend a whole lot on metaverse type things. It would probably spend money. So it coming in line for the year guy was a little bit of a surprise. There's a lot to not like about the quarter, but I'm wondering if the stock has found a floor.
So Karen makes a great point. Let's go back to 2018 because I think it was July of that year. The stock was making an all-time high of about 207. Then they had that quarter. She mentioned all the headlines they had. And by December, basically Christmas Eve of that year is when it bottomed out, I think around 125. So this is not unprecedented. The stock made an all-time high in August. So in terms of the calendar, it's starting to line up. The number that, of all the numbers we mentioned, and they're all sort of lousy, the one that we should mention is operating margins were disaster, in my opinion. This quarter last year, 45.5%, 37.5%. You can say, okay, I get it, but still a lot worse than the street was looking for. The question is, you know, are we in that same type of thing where you have a few months of this stock underperforming? I mean, again, I mentioned this stock topped out in August. It's now February. Maybe we're getting close. By the way, I did not expect, I don't think, well, clearly nobody did given a 22% move, but I think this is catching a lot of people off guard, but it's eerily reminiscent of what we saw the summer of 2018.
Now, it is rare when you find so many people getting the story so wrong going into a print. I mean, if you consider the 52 analysts on Wall Street who cover the stock, 42 of them, 42 of the 52 have either buys or market outperform ratings on the stock. That's how offsides the street is on the story at this point in terms of this print and the guide, Tim.
It's hard for them to have been in any other place when you think about the valuation coming into this, and however you want to look at Facebook, 22 times trailing, you know, and now, you know, it's probably 16 or 17 times forward. I think, you know, you're looking at around 1350 to 1450 is your range there on 2022. Look, I think everyone flagged the dynamics on CapEx and spend and guys' emphasis on margin concerns. I think the shocker is that 3 to 5% Q1 growth, and I think it's, you know, we're going to talk a little bit about how some of the other social media names have fared here, but obviously this started with Netflix, and when you get this kind of an outlook on the next quarter at a time when, look, a lot of people are still need for this quarter, for 2022 growth to be, you know, north of 15% to get anything close to those numbers that they're talking about. So, you know, that's the part of this. What I heard in there, too, that concerned me was just the competition for engagement and advertisers possibly then following through on that. And this isn't just Facebook's issue. But the fact is that Facebook is the biggest, and there's not a lot of other places for advertisers to go. But the fact that they're also talking about the competitive landscape, and this seems to be a theme, even though these trends are secular, and these are the biggest companies in their spaces.
And I think that would be the biggest concern when you think about that forecast of 3 to 11% revenue growth in the first quarter. The biggest concern is the impressions. They said specifically that they're competing for people's time with other things, which is not going to go away, which is only going to get worse as the pandemic restrictions continue to lift. And then within that, there is a shift within their apps, within their family of apps, to apps that monetize in a lower fashion. So Reels as opposed to their core, Grasso. And if you look at the trends, that's what's hot these days. TikTok, YouTube, it's the video stuff that doesn't monetize as well.
Yeah, I was going to say, so we have all the headwinds are Apple privacy still a headwind, TikTok popularity, metaverse spend. It sounds to me like they're distracted. And what happens when you're distracted is you spend a ton of money and you wind up taking your focus off the ball. We're not worried about congressional regulation anymore. We're worried about eyeballs. We're worried about spend. And we're also worried about the fact that you said this is rare when it happens. We're seeing this more and more with the after-hours swings. Netflix, Google to the upside, Netflix to the downside. We're seeing these mega cap tech names trade like they're $5 stocks. This is tremendous. It doesn't do anything for confidence, for investor confidence. So everything that we gained in the last day or so is probably out the window. I'm more concerned what it means for the overall macro market than what it means for large cap tech.
I think that's an interesting point of view. I mean, if you think about the investors who thought, oh, they bought smart when they bought the NASDAQ dip a few days ago, and here they are, all those gains are basically gone. Guy, I mean, that's damaging when you're looking at a market that's struggling to find its footing.
Yeah, I think that Steve makes a great point. And the fact that a stock of this size can move 22% in the after hours is remarkable. Now, that move in Google is just as remarkable. The only reason we don't really talk about it in a negative way, obviously, is because it went higher. But, people panic to the upside and to the downside. I think we sometimes use the word only on the downside, and I think you've seen it both ways. What does it mean for the broader market? You see the drag that it's having on some of these other ancillary names that haven't said a word. Snap, Pinterest, I'm sure Twitter's lower as well. My sense is, whether justified or not, Amazon's probably lower in the wake of this. So the effect that it has on the broader market, given the bounce we've seen off the lows, could make for a really interesting day tomorrow. With the VIX, it's still north of 20.